The stock market is always a very volatile place. Like today, it can go up 5%. Tomorrow, it can go down a lot more. Don't say you lah. Sometimes I'm also scared lah. That's why Syfe has recently came out with their latest Downside Protected Portfolio, which is designed to let investors earn the potential upside while protecting them against downside losses. In this video, I'll be going through everything you need to know about this portfolio. What is it? How does it work? What are the risks of this portfolio? And who this portfolio is suitable for. But before I start, full disclosure, this video is produced in collaboration with Syfe. But rest assured that all views here are entirely my own, and everything that I state here are my own honest thoughts. Alright, here's an overview of how the protected portfolio works. The protected portfolio has two key attributes: the estimated max loss and the current upside cap, both of which can change from time to time. So in the event that the market drops by a lot and everyone is panicking left and right, you can be like, this is fine because this portfolio limits your losses to around the max loss cap. On the other hand, if the market goes up, you will also get to enjoy the returns all the way until the upside cap. But then you might ask, why is there an upside cap? Why not just, just cap the downside and let the portfolio go all the way to the moon? Here's why. This portfolio is constructed using a series of downside protection ETFs. In it, you'll find three options, each with a different purpose. First up, it buys a very deep in the money call option in order to track the performance of the S&P 500. Here, I can't get a strike price that's as low as theirs, so I'll just use a stock position to represent this. Next, it buys a put option to provide downside protection. So let's say if I don't want my position to drop more than 5%, I will buy a put option at a strike price 5% below the current stock price. And you can see that once I added this put option, no matter how low the stock goes, it will never go below the max loss. But then you will notice that I now have a net debit of about $3,000. That's because this put option costs over $3,000 to buy. So in order to pay for this, I will need to sell a call option. Selling a call option lets me earn a premium, which I can then use to pay for the put option. So if I want a 10% upside, I will sell a call option at about 10% above the current stock price. And once I added this call option, you can see that I now have a net credit, which means the put option is now fully paid for. But in return, my upside is now capped. So no matter how high the stock goes, it will never go above the upside cap. Fun fact, this is also known as the collar option strategy, which protects your downside while allowing you to participate in the potential upside up to a certain limit. Now, some of you will start to see the problem here. If you are capping your upside, then wouldn't you underperform the market when it goes up by a lot, like what happened this year and the previous year? While there have been huge market crashes every once in a while, historically, the S&P 500 has most frequently returned between 10 to 20% worth of returns, which is beyond the current upside cap of the downside protected portfolio. And if you keep missing out on 5 to 10% a year worth of returns, you would be missing out on 27% to 61% returns over a 5-year holding period. So here's where Syfe comes in. What they will do is that they will look at things like risk to reward, market condition, time left to expiry, and other factors to periodically replace existing ETFs with newer ETFs whenever needed. This is an illustration of how the Syfe Downside Protected Portfolio works, based on scenarios backtested over the last few years. You can see that the blue line here, or the Downside Protected Portfolio, follows the S&P 500 and tries to capture the growth. Then there's also the dotted green line, aka the current upside cap, and the dotted red line, which is the downside protection, are re-optimized as time passes. So as the portfolio goes up in value, your gains are getting protected. At the same time, the portfolio lets you capture even further upside. So for example, you started this portfolio at $100 and it has a downside protection of 3% or $3. Let's say this portfolio has now gone up by $10. Before the re-optimization, you can stand to lose your initial $10 gain and the original $3 downside. But as soon as the portfolio is re-optimized, since the downside protection is raised up, it now protects that $10 that you have gained, effectively letting you crystallize those gains. At the same time, since the current upside cap is raised also, the portfolio is now able to go from $10 gains up to the next $20, the next $30, and so on. So as you can see, as the portfolio is re-optimized, it lets you lock in the gains while giving you more upside to go. But how does this portfolio compare against other asset classes? According to Syfe backtest results, they found that the downside protected portfolio had lower drawdown as compared to the S&P 500 index and even the US aggregate bond index. For example, during the pandemic crash in March 2020, when the S&P 500 crashed by over 30% and the bond index crashed by over 18%, the downside protected portfolio only fell by a small 3.8%. Likewise, in 2022, when both the S&P 500 and the bond index fell by over 24% and 17% respectively, the downside protected portfolio only fell by 2.7%. Now, of course, the downside protected portfolio also gave lower returns as compared to the S&P 500 during this period. But in return, the downside protected portfolio showed lower volatility. This gives investors a much smoother ride than if you would have directly invested in the S&P 500. Which brings us to the question, given that this portfolio caps your upside, why would anyone want to invest in this portfolio? Yes, it's true that if you are a long-term investor who can invest over the long term, it's better to just directly invest in the S&P 500 to get a much higher return. That's because you have the time horizon to hold and wait for the market to recover. But there are also times when investors don't really need the high return. Instead, they just want to earn some potential returns while having as little risk as possible. This could be your risk-averse investors, such as a new investor who is just starting out and is worried about losing money, or retirees who just want some stability while they are drawing down on their portfolio to pay for their living expenses, or short to mid-term investors who are saving up for large expense in the near future, like their wedding, house, or kids' education. And even if you are an experienced investor, this portfolio could also act as a diversifier to help reduce overall downside risk and volatility. Besides that, with interest rates going down, this portfolio can also offer cash-rich investors who may be waiting for a market dip, while getting some potential higher returns as compared to bank interest, bonds, or money market funds. Now, let's talk about some considerations when investing in this portfolio. 1. The downside cap is not guaranteed. If we look back at this chart, you will notice that this portfolio may sometimes fall past the estimated max loss. This could happen in extreme situations where there are significant unexpected moves and high volatility, which can cause option prices to fluctuate wildly. But as the market stabilizes and as you stay invested, the option prices will return back, bringing the portfolio value within the expected ranges. Second, the fees. Besides the usual Syfe managed portfolio fees of up to 0.65%, there's also the fund level fee of around 0.79%, which may eat into your returns. But according to Syfe, the estimated max loss and the upside cap that you will see on the website or the app are actually inclusive of the fund level fees. So it already takes into account the potential fees incurred over the next 1 to 2 years. The other reason the fund level fee is high is because the downside protection ETFs are rather new to the market, and there aren't that many similar ETFs yet. But with BlackRock entering into the space, we might soon see fees being lowered as competition heats up. Third, given that this portfolio relies on Syfe to periodically apply investment techniques and risk analysis in order to re-optimize the portfolio, I was curious what would happen if Syfe makes a mistake when re-optimizing the portfolio wrongly. So of course, I had to ask them about it.
From a Syfe investment perspective, we design these managed portfolios in a very objective way. There is an investment principle that we strictly follow. We have an investment team in-house. We define that methodology, and we have a clear-cut objective of what that portfolio needs to be. Periodically, we monitor, we assess the risk rewards, assess the market conditions. If as and when needed, we re-optimize, rebalance the portfolio. So to your question, could there be a scenario where something could go wrong? I think unlikely.
Now, given that re-optimization requires a consent, what will happen if the user doesn't give a consent? Will the upside be capped forever?
For clients who opt out, they will still not be capped because the underlying constituent ETFs that we select, the ETFs themselves have an inbuilt mechanism of restriking the options. The ETFs generally that we construct have options expiry within 1 to 2 years. So as and when then those options expire, the options will protect 100% of the prevailing market. So clients at that point in time will benefit from the gains from current level. When the ETFs restrike, or the options within the ETF restrike, they will protect most of the S&P level and then unlocks even higher upside than the initial ones. So for people who opt out, they have to wait for those options to expire, which could be 2 years, which depending on the expiry or the methodology of the ETFs. While people who opt in benefit from us monitoring the space to capture further upside. We would rebalance as soon as S&P reaches that level. So they get the benefit to proactively capture even higher upside without waiting for the actual expiry.
What will happen to the portfolio in the event of a prolonged downturn, like a lost decade where the S&P 500 crashes and stays there for the next 10 years?
We will continue to protect the downside for the investors, but then give the opportunity in the portfolio to capture if the S&P bounces back. So investors' downside losses will still be continued to be protected even when we reoptimize. So that's like the option number one for clients who wants it to be completely hands off. We will do the job for them. The beauty of protected portfolio is that they're not locked up. People can go in and out. So some sophisticated clients can switch from protected portfolio to our equity 100 portfolio, or like 100% equity portfolio, to capture the bounce back as well. We will always be active or proactively nudging clients on what are the options available, and for people who wants it hands off, we will reoptimize. People who wants a bit more control, we are here to guide them, advise them as and when needed.
So that was a quick review of the Syfe Downside Protected Portfolio. If you are interested to try them out, currently I have an exclusive partnership with Syfe, where if you use my code to sign up, create and fund your downside protected portfolio by November 2024, you get to invest for free for up to 6 months after signing up. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe, as I'll be posting new videos every Monday, Wednesday and Friday.